Good morning to those of you who are starting to log in. We'll be kicking off this session at 10 o'clock. Good morning to people starting to log in. We'll be kicking off this webinar at 10 o'clock. Good morning, everyone logging in, and we'll be kicking off this call in a minute or two's time at 10 o'clock. Good morning. As we've still got a lot of people logging in, we'll be starting in just a minute or two. We'll just give it another minute or so for latecomers joining, and then we'll kick off. Good morning, ladies and gentlemen, and welcome to this AREF, INREV and IPF member webinar on the UK Treasury's funds review. Today we'll be considering the implications for the real estate fund sector of the Treasury's call for input published in January. In the 2020 budget a year ago, the Chancellor announced that the government would undertake a review of the UK funds regime during 2020. There have been two broad areas of consultation by the Treasury since then. The tax treatment of asset holding companies in alternative fund structures, which started immediately from March 2020, to which AREF, INREV and the IPF responded, and a broader review of the UK funds regime in the form of the current call for input. Although we will touch today on the broader consultation, we will be mainly focusing on two possible new fund vehicles covered in the call for input. The long-term asset fund, which has been promoted by the Investment Association, and the professional investor fund, which has been promoted by AREF. To discuss this, we have an expert panel today. Peter Capper is Fund and Investment Risk Specialist at the Investment Association. Anshita Joshi is the Tax Advisor at the Investment Association and the Association of Real Estate Funds. Melville Rodriguez is a consultant recently set up as an independent consultant advising on the launch and operation of real estate funds. And last but not least, Christopher Austin is Head of Tax for Private Markets at Schroders. And fuller biographies are on the various websites if you want to find out more about your speakers. We want to make this session as interactive as possible. So if you want to ask a question during the session, and there's two ways of doing this. You can either use the Q&A panel and put your question in there, and I will pick up those questions when we come to the Q&A session. Or once we get to the Q&A, you can use the function to raise your hand, and then Eve at AREF admin will send you a message to unmute yourself. You need to click on that and unmute on your own computer, and then you can join the discussion live. With that, I will hand over to the first presentation. Peter and Anshita are going to cover the long-term asset fund. So Peter and Anshita, over to you, please.
Yeah, thanks, John. Good morning, everybody. So perhaps we move on to the next slide, please. Eve, thank you, and then after that one. So I'm going to very briefly just cover the long-term asset fund proposal before handing over to Anshita, who's going to be looking at the tax implications for the LTAF, and then I'm going to just very briefly conclude with some comments on what we're seeing in terms of latest developments and perhaps a broader context. I think we're slightly limited for time, so I'm going to be running through this fairly quickly. So perhaps this is not a session to sort of play on 1.5 speed. So perhaps if you go on to the next slide, please, Eve. Thank you. So very briefly, the proposal was for the long-term asset fund was one of the proposals that came out of our UK fund regime working group in 2019. This reported to the Asset Management Task Force, and essentially for the long-term asset funds, we were looking at a vehicle really that could try to facilitate broader private market access, for broader investor groups. So really looking at areas such as infrastructure, property, private equity, and private credit. And in particular, there were some investor groups that sort of fairly sort of cash-rich investor groups that where managers were looking to make sort of small allocations to alternative asset classes. We tried to both diversify returns, but also to benefit from some of the illiquidity premiums available in these alternative asset classes. So in particular, the DC default pensions schemes and private wealth managers, populations that require retail products, but sort of perhaps have a bit more means to make small allocations in this area. So really, this is the sort of audience that this proposal is aimed at. And I think we'll come on to the PIF proposal later, which Melville and Christopher are going to discuss. Which I think we see very much as complementary, because this is aiming at a slightly different target market, and we'll come on to that a bit more in discussion afterwards, hopefully. So perhaps next slide, please, Eve. So the key recommendations of the original proposal really were that it should be an authorised fund that was marketable to retail, and we saw the easiest route to achieve that would be to use the existing NERS structure, but to create a subset of rules for that. And the key proposal really extends around both extending the investment powers that are available, so that investments could be made fully in unlisted securities, alternative investment funds, unregulated investment funds, limited partnership, including limited partnerships, and private debt contracts as well. So as well as perhaps more existing asset classes such as real estate. Although we primarily saw this as a vehicle to open up new asset classes rather than to replace those already in place for, say, the property fund sector. Although that potentially could be part of a mix of a private assets portfolio, real assets portfolio. So, and to really make that work, we recognise that there would need to be very different dealing terms for this sort of product compared to the regular, the regular sort of daily, the existing daily price market. It just wasn't going to work, and not at least without very substantial holdings of liquid assets in a portfolio like this. So we've suggested that the rules on redemptions in particular, and there should be notice periods and more limited redemption periods to align it to the liquidity of the underlying assets, or more closely aligned to the liquidity of the underlying assets, coupled with strong investor protection measures. I'm going to go on to the next slide, please, Eve, if that's okay. Brilliant. So we've further developed the proposal leading up to over the last sort of 18 months, and we published it. We presented a further paper to the Treasury, Bank of England, and FCA last year, which is now public and available on our website. Essentially, this built on the original proposal, doesn't radically change it, but built on the original proposal. Expanding on areas such as some of the detail and areas such as existing asset classes and the rules that we felt potentially could apply to allow targeted retail investors to access this product. We also set up some hypothetical examples and really sort of explored further some of the barriers around permitted links in that paper. Again, apologies for the speed of going through this, but we've got a lot to cover in this webinar. So I'm going to hand over to my colleague, Anshita, now is going to very briefly talk about some of the tax points. So to you, Anshita.
Thank you, Peter. And thank you, John, for that kind introduction. Just very briefly, Anshita Joshi, Head of Tax at the IA, and I also support the AREF Tax Committee. As sort of Peter mentioned, long-term asset fund is one of the areas that we've been looking at for quite some time, more from a sort of regulatory framework point of view, but recently as well on some of the tax implications. And indeed, interestingly, the call for input on UK fund regime that's been recently released, recognizes that those regulatory conversations are going on separately, so that doesn't really try to sort of repeat those questions or ask the questions that FCA and other groups are already considering, but it does on the sort of tax side, ask a very important question to the industry, which is what about the tax rules for LTAF? And for most aspects, the sort of current government intention is for the existing authorized fund tax rules to apply to long-term asset funds. And we've been sort of this end looking at what that would mean from from an LTAF point of view, where potentially issues might come up. Initial feedback from IA and AREF members so far suggests that pending FCA consultation that is expected to be issued later in spring, it is currently sort of difficult to look at sort of all of the different aspects of tax treatment, as this it'll obviously depend on the type of authorized fund vehicle and what sort of investors and investments indeed that the fund makes. Next slide, please, Eve. Thank you. So I guess just as a starting point, I think one of the areas where we've had sort of more feedback from members and sort of more clear intention is around, based on the expectation that the LTAF does adopt the open-ended structure proposed by the IA, and at the initial stages is available only to DC pension investors. Then possibly the UK co-ownership, authorized contractual scheme structure, the ACS structure, seems the most sort of immediate sort of appropriate vehicle of choice. And that's for a number of reasons in terms of, being able to easily manage it for those sort of exempt institutional investors, and being able to deal with, varying sort of types of assets underneath that structure as well. ACS is effectively sort of tax transparent. So, using the current tax regime that is available seems an appropriate sort of, again, first choice for LTAF. As I mentioned, a couple of minutes ago, obviously to the extent that, FCA discussion progress to really extend that nature of investors and indeed investments, considerations would need to be extended to sort of LTAF taking possibly an OIC form or others, and indeed some of the tax changes that might need to be looked at. If, for example, affluent or retail investors were permitted in an LTAF, then you could potentially, to the extent that you were using something other than an ACS, would potentially have the issue of tax leakage for balance funds that the call for input specifically recognises in Chapter 2. Which is already an issue for UK authorized funds, but particularly for LTAFs that say use a combination of different strategies and end up having a mix of investments underneath. Any tax leakage at an LTAF level is something that from an industry point of view would need to be managed, and indeed that requires HMT and HMRC, or would require HMT and HMRC discussion in terms of how do you manage that, and indeed overall complexity of the UK fund regime would also need to be sort of considered, where an LTAF invests across a range of assets that Peter sort of earlier alluded to. So I think from a sort of overall perspective, where we are at on the sort of tax side at this point in time is to the extent that an ACS vehicle was being used, that appears to be sort of the first choice, and indeed a suitable and ready to use choice, I guess, from a tax point of view as well. However, further discussions would need to be had to the extent that we're talking about other UK fund vehicles being used for LTAF. I quickly wanted to mention also, so that need to sort of accommodate UK property to the extent that LTAF were, as part of their portfolio, looking to accommodate UK property. We know that the government's intention is to ensure that UK property sort of effective taxing rights are maintained. So, conversations again will need to be had to the extent that any of the fund vehicles are looking at holding, as part of wider portfolio, also UK property within them. So that's sort of very broadly on the direct tax side, or sort of fund tax side are some of the considerations. If you could just move to the next slide, please, Eve. The second part of the question that's been asked in the call for input sort of relates to, what other tax considerations need to be considered or are important for the success of the LTAF. And there are sort of number of things that have been that have sort of come up through member discussions. I'll probably start with seeding relief. I think that's been one that there's more. I think there's a clearer message on, which is, you would need, to the extent, as with all new products, to the extent that you're talking about a new sort of fund vehicle in the UK, seeding relief would need to be available, and from an ACS point of view, for example, that currently already is available. So potentially no tax changes would be required to make sure that it continues to be available, but it certainly is one that's important from a member point of view. The second big question really is on the VAT treatment, without sort of any changes being made to the VAT regime. And we know that a consultation was announced last year indeed, by the Chancellor to review the VAT treatment of management fees in the UK. But it's yet to be released. And one of the key messages that's been coming up from members is that review really needs to happen alongside the wider call for input on the UK fund regime, on the basis that number of changes that are being, that need to be looked at in terms of simplifying the UK VAT regime and making it more competitive would have an impact across the whole piece, including the long-term asset fund. At this stage, the intention is without that review, current VAT rules for management, management fees sort of will apply to LTAF as well, on the basis that it's using the existing fund infrastructure. But there's a broader call there in terms of making sure that overall review around competitiveness and simplicity is done sooner rather than later. I wanted to just very quickly, conscious of time, I wanted to quickly mention the UK AHC review and that John alluded to, and that's not necessarily sort of critical to or specific indeed to just to LTAF or indeed the professional investor fund, but obviously that is one of the one of the goalposts in the future in terms of UK actually offering not just fund vehicles of choice, but also holding structures underneath. But at this point, the intention is, absence a suitable UK hold AHC regime, the UK AHC would be the sort of LTAF would just be using overseas holding vehicles. I'll stop there. I've sort of put a question mark against tax incentives, and that was more of a broader question, and comments welcome during the discussion later on in terms of any specific tax incentives rather that people think would be useful, or that they've thought about in terms of the LTAF, or indeed the underlying investments needing in order to encourage investments. That was a very quick canter through, but I'll pause there.
Yeah, thanks, Anshita. Can we go on to the next slide, please, Eve? So very quickly, just to wrap up, what we're seeing in terms of the latest timeline, I'm just going to make a couple of points here. First of all, we had the announcement last year from the Chancellor of the Exchequer in Parliament, who committed essentially that there will be an LTAF that will be out there by the end of this year. So it's really accelerated the timetable for this. To facilitate this, the Treasury, FCA, and the Bank of England set up a productive finance workstream that is considering the broader areas of the infrastructure, both the fund structure, the form the LTAF might take, and broader barriers to making long-term investments. So including some of the issues around amongst distributors and platforms and so on. So. That work is due to give its recommendations by this summer. We're also expecting an FCA consultation of the LTAF, but with the timeline somewhat uncertain. But we're looking at probably in the next couple of months for that to come out. In terms of just going to the final slide very briefly, I think we'll probably discuss some of this in the questions. But I mean, we always saw the LTAF as a more gradualist proposal, really something that those who are ready to move forward with a not in a non-daily price world could start to adopt. And some of the platforms could start to adopt, but we recognise there are challenges in the wider in the wider ecosystem. Some of the consultations that come out last year perhaps haven't been terribly helpful in terms of signalling over retail access in liquid assets. The HMRC consultation license being one of them. I'm conscious of. I think we need to move on to the next presentation. So thank you very much for, and we'll look forward to the question discussion. Over to you, John. Thank you.
Thank you, Peter, and thank you, Anshita. And I know Anshita has to disappear before the end, so but we'll thank you for your contribution. We now move on to Melville and Christopher, who are going to talk about the Professional Investor Fund. Thank you, Melville.
John, thank you. And ladies and gentlemen, it is terrific that within the call for input, the government is considering legislation for the PIF alongside other proposals. In the call for input, the Treasury asks the question, what do you think the top 3 priority proposals should be for government implementation and why? I urge you and your organizations to respond to the call for input. Join AREF, INREV, IPF in supporting the PIF and advocating it for legislation. Let me explain the need for the PIF. There is a gap in our UK fund offering. From a real estate perspective, UK underlying real estate, UK based manager, UK professional investors. There is currently no available unlisted closed-ended hybrid tax transparent fund with tradable units. The manager, the investors are having to consider alternatives, onshore, open-ended, or alternatively go offshore. Both have drawbacks. We need to solve the gap. The PIF solves the gap. I will explain about the legal and regulatory aspects. Christopher will follow with the tax implications. As Peter and Anshita mentioned, the authorized contractual scheme, the ACS, the PIF is based on it. It is simply an unauthorized. In other words, it operates as being closed or hybrid. It has the equivalent investor base, professional investors, minimum subscription of £1 million. Investors are protected with a UK AIFM and depository. And it operates similar to an English limited partnership with notifications to a registry. Another attraction is that senior counsel has advised that the PIF legislation can be implemented within months this year by way of secondary legislation. The PIF addresses industry's need. It's one for which we've had overwhelming support over the last couple of years from fund managers and elsewhere. I'm so grateful to AREF for endorsing the PIF proposal and for IA for including the PIF within their onshore professional fund proposals. Peter mentioned the PIF complements the LTAF. And in relation to productive finance, I suggest that the PIF could be a useful conduit. So the PIF addresses industry's needs. And in addition, I would argue that it is aligned with government policy. Post-COVID reconstruction, the reinvigoration of our town centres, capital into social and affordable housing, investment in our domestic infrastructure. And in addition, the PIF proposal combines with robust tax anti-avoidance provisions. I urge you and your organisations to respond, endorsing the PIF proposal. There's a link here to my own blog, which contains detailed precedent responses to the relevant call for input questions. Or alternatively, if you would prefer a briefer response, in my final slide, I have text whereby you can support the responses to be submitted by AREF, INREV, and the IPF. Please take the initiative, respond to the call for input, and support the PIF. Thank you. And now over to Christopher, who will explain the tax aspects of the PIF.
Thank you, Melville. Hopefully for some of you, this will be a reminder, next slide please, Eve, of the tax attributes. The design of the tax scheme, like the regulatory scheme, is to build on existing legislation. So obviously this again allows very quick implementation, very little legislative change is required. It will provide a structure for the scheme that is well understood by investors and by fund managers and platforms. And it's consistent with an approach that looks to detach the tax treatment of funds from the regulation and the liquidity requirements of the funds. And that allows potentially a mix and match approach, much like in Luxembourg or other countries, to allow funds to be designed from a tax perspective and from a regulatory perspective to fit the needs and the profile of the investors and the assets that are being held. From a direct tax perspective, it's a fairly familiar structure. It's common to many structures offshore and onshore. From an income perspective, it replicates direct investment by being tax transparent. This allows investors to access their double tax treaty rights, and obviously within a closed-ended structure, it is practical to do so, which isn't as easy in an authorized context where there's frequent dealings. The capital gains tax treatment is that there is no tax within the fund, and then investors, if they're taxable, pay tax on the disposal of their interest in the fund or receipt of capital from the fund. And then there's a simplified capital allowances regime that's appropriate for this kind of structure. On transfer taxes, so common to many vehicles, essentially other than partnerships, there is no SDLT on unit dealings. This is clearly a key attribute that would need to be there in order to make it work as a structure. As Melville has already mentioned, when the government introduced partnership interests, that sort of closed down that structure completely as a fund vehicle, even though what was really being targeted was more SPVs designed to avoid SDLT rather than funds. As Anshita has already alluded to, seeding relief is very important to kickstart a regime by allowing existing portfolios to be transferred into the new structure, whether that's an existing ACS that opts to deregulate or a large portfolio of assets being transferred by a seed investor. Seeding relief will obviously provide a competitive advantage compared with offshore structures, which will help to boost the regime. And it's already available to ACSs and PAFs, and therefore it would be consistent with that to allow a seeding regime. Obviously, in the context of a seeding regime, there is the potential for avoidance. Therefore, there will need to be some kind of protection. That could be based on some kind of genuine diversity of ownership test, combined with a test of non-closeness or a test of being held by a majority of institutional investors. It's also worth bearing in mind that the existing seeding reliefs already require portfolios of 100 million or more and at least 10 commercial properties. So it should not provide an easy route for avoidance, and therefore hopefully HMRC will accept that is sufficient protection. A question might be asked as to whether in the context of an unregulated scheme, 100 million is too much, and perhaps that's a discussion that could be had in due course, but certainly there are quite strong protections already in place. From a VAT perspective, as Anshita has already covered, this is quite a complex issue, particularly for real estate, and therefore our proposal is that this just needs to be covered as part of the wider consultation on VAT for investment management fees. Next slide, please. So just to run through this, these are the key objectives set out by the government in their call for evidence. And I just want to explain why I think that this is a good fit for those objectives. So clearly, it does make the UK a more attractive location to set up, manage and administer funds, particularly if there is a seeding relief available. It will be a very attractive regime, and there is certainly demand from investors to have an onshore equivalent from to the current offshore structures. It will support a wider range of more efficient investments, and it will work well as a platform for all kinds of real assets and other private investments. It will better suit investors' needs. So currently the issue with an ACS is that there is a need to maintain liquidity. For some, the LTAF will be a solution to that. For others, where a fund wants to really drive performance and doesn't want to have any kind of requirement to maintain a liquidity buffer, it needs a closed-ended approach. It is compatible with a robust approach on tax avoidance and evasion. There is no tax advantage in that investors get transparent treatment. They are taxed in the same way as they would be for holding the underlying assets. The seeding relief is one issue that I've already talked about there, but I think that there is a good reasons for saying this won't be a route for avoidance. And it does effectively allow real estate income to be taxed, or other UK sourced income to be taxed appropriately, depending on the investors. So thank you. I'll hand back to John for the Q&A.
Thank you very much, Melville and Christopher. We now have about 25 minutes up until 11 o'clock for Q&A. Again, remind everyone, if you've got questions, can you either put them in the Q&A box or raise your hand with the electronic hand signal. We have already got some questions coming into the Q&A, but before that, I wanted to pick up on a couple of points that struck me as particularly interesting to throw back to our panel. The first one, Peter and Melville, you've both said that the LTAF and the PIF are complementary, and there were a couple of aspects of that that struck me as potentially interesting to explore. The first one is just the use of LTAFs to invest in a broader range of sort of real estate and real assets products that are challenging for investors at the moment. So real estate debt funds and things that are not conventional direct property funds. And the second was the idea of LTAFs, sort of gathering DC and certain retail money and then investing in underlying PIFs as an investment product. So the LTAF pulls the money and then it invests in PIFs offered by other managers. Could you? I throw that thought out to you to start the discussion before we open up to some of the other questions coming in. I don't know who wants to start.
I'm happy to say a couple of thoughts, perhaps, and then hand over to Melville. So I completely agree. I think one of the core ways that LTAFs will get exposure in many asset classes, especially those that are focusing on more than are trying to offer sort of perhaps a more generalized private market asset. Those managers are unlikely to have the will not necessarily be sort of experts at all the asset classes, so we're likely to be making they're likely to invest in funds rather than necessarily always investing directly in assets. We're trying to design LTAF so that direct asset investments can be made as well, but undoubtedly having suitable alternative investment vehicles and regulated vehicles will be very important to gain access to the underlying asset classes. At the moment, the feedback we've had from members has generally been that as the fund structures that work best for this are those that are outside the UK, and in particular the Irish QUAIF and the Luxembourg RAIF. So I think the PIF provides a very exciting alternative in a UK sort of base structure that could potentially be used by LTAF managers. And perhaps now if I hand over to Melville for some further thoughts, perhaps.
Thank you, Peter, and an interesting question. Yes, the PIF, the LTAF complement, and for me the key is liquidity matching, investor level and underlying assets, and the LTAF in attracting DC and that type of investor base may well find that the PIF is a useful conduit for attracting exposure to less liquid assets on a diversified basis. Real estate debt, private equity. So there's a wonderful way in which they could both combine and achieve government's goal of enhancing our UK fund offering.
So, I mean, effectively, I think what we're saying is the PIF is a fund for professional investors. And the LTAF could be a professional investor in that fund and then distributes out to a range of investors who are either not professional investors or need sort of slightly different characteristics. One of the questions that has come in is over the timetable. I mean, I know the original announcement in November was that this would be within a year. How realistic do we think that is, and have we got any clues as to when the sort of the next steps might be on the consultations?
Yeah, so it's probably worth mentioning that the UK fund regime consultation by H&T doesn't feature the LTAF very heavily, largely because the proposal builds on existing legislation, and so it hasn't required a heavy amount of legislative changes on the structure side. Clearly, on the tax side, there is quite a lot to do, as Anshita and Christopher have mentioned. But we are expecting a consultation with the FCA fairly soon. The FCA is also taking input from the Productive Finance Working Group, so that timetable has affected perhaps the FCA's consultation timetable. Clearly, the timetable set by the Chancellor is very ambitious. As an association, the IE won't be launching any products, so it will ultimately come down to individual managers, and they'll need to be convinced of the proposition, and part of that will be influenced by the sort of target markets, but clearly that still also represents a great opportunity for the industry, and especially with some of the drivers such as COVID recovery, and also some of the wider ambitions for infrastructure spending, that this is potentially and sort of supporting productive parts of the economy. This does essentially present a sort of a good opportunity for managers.
And if I could endorse, from a PIF perspective, we want to match the ambition, that timetable already set for government for the LTAF. So very easily, if we have positive endorsements to this call for input from industry rep bodies, from fund managers and others within our industry, let's hope that government will then be able to escalate and adopt a secondary legislation solution. And it could well be that the PIF is implemented into legislation on the same timescale before the end of this year.
I mean, on that, Christopher, one aspect of this is obviously there's potentially some significant tax aspects as well. I mean, is there any risk that HMRC are going to sort of bowl in a curveball like they did with the ISA consultation that sort of came out the blue and no one was expecting and kind of demolishes the whole thing?
I mean, I would hope that that isn't the case. We've certainly been in discussions with HMRC over a fairly extended period on this, and we have some good relationships with the policymakers at the right level, with both HMRC and Treasury. So they've certainly had a lot of time to think over this proposal, and the fact that they have included it specifically in the call for input indicates, I think, that there is support there at the government level. I think in timing terms, this is an ideal opportunity with the government now wanting to show Britain's place in the world, and dare I say it, it's now easier for the government to put through changes without having to go through the same processes that it used to have to happen in terms of state aid and so on. So there are some potential opportunities there.
Is there any news on the ISA consultation that came out? I mean, that was part of the kind of other consultations on open-ended property funds, but that has a knock-on impact on this as well. Do we know where things are on that?
I don't know where we are on that. I'm afraid I've not seen anything new.
Do you have any clues, Peter?
I don't, unfortunately. I think we, I think to be fair, I think there was a fairly strong industry response, both from the likes of AREF and the IA to the consultation, which I think is being taken on board, and clearly the IA, as I'm sure AREF did, flag some of the issues that came out and some of the signaling that came out of that consultation to other parts of government, Treasury, and I think we're sensing there's a real desire now to sort of bring different parties together. I think that's what the sort of productive part of what the productive finance is trying to do. So look at the whole piece, the different parts of the distributed trade, not just the top sort of product level. So we're keeping our fingers crossed on that one, but at the moment we don't have a sort of sense of what the next steps are likely to be on that.
Thanks. Now there's a couple of related questions that sort of follow on for each other. The first is I think the suggestion is that the PIF will be a form of ACS. And the LTAF very well might be a form of authorised contractual schemes. I mean, how widely used are those in the UK? Is this going to be a sort of completely new thing for most people?
Well, I'm happy to go first. Clearly, the ACS has benefits. It's been utilised in the context of LGPS pooling, but from a real estate perspective, authorized, open-ended, so it creates the challenges of liquidity matching. Hence, that is why adopting that as a closed or hybrid feature just makes eminent sense. And all credit to those within industry, including the IA, who put through the ACS legislation. It's a stepping stone for which we advocating the PIF are looking to utilize, and clearly the LTAF could equally benefit from.
Peter, did you?
Yeah, I mean, as Melville says, I think the ACS has gained ground in recent years, especially in the pensions world. and LGPS pools in particular have made use of the ACS structure. I mean, I'd say it's been used mostly, I think, to hold conventional assets to date. But I mean, it could be part of the solution for LTAF, especially those that are aimed at sort of DC or other investors. But I also think that, I think for perhaps LTAF to reach its full potential, it needs to be available. It needs to be workable in other sort of authorized fund structures, such as OIC, in particularly the OIC, but also the unit trust. So I think we certainly see potential for ACS, but that will depends on which on who you're structuring the fund for, as is the case in any fund offering.
Interesting related comment from Andrew Smith that I mean these although ACSs are in use, they may be these may be structures that are unfamiliar to the type of investors that we're marketing the products to, and has there been any thought given to what the industry associations could do in terms of producing information packs or other things that managers can use to help sort of explain these to investors, deal with investor DD, etc.?
Yeah, I think that's a terrific idea from Andrew. How I could analyze it from a legal base is within our Anglo-Saxon world, US, Brit, we're familiar with limited partnerships. The contractual scheme comes from a civil law heritage, and it's one where they are both very similar. And another interesting factor is how each of them compare from a treaty perspective. So good idea that assuming progress with the PIF, with the LTAF, there should be that education. And maybe Christopher, you could comment about the respective tax treaty treatments.
Yeah, sure. So I think the key to making this successful and something that we can, as an industry, market to investors is that it is simple and easy to explain. And that means that we need to have a structure that investors are familiar with in terms of how it will work. It is in a lot of ways very similar to a partnership structure or to contractual schemes in civil law jurisdictions. Because of that transparency combined with capital gains tax exemption, it's got a lot in common with, for example, Jersey property unit trusts, which property investors are very familiar with generally. So I think it is not, it's not completely new to investors, and I think that's key. I think if we're going to persuade investors that this is a better vehicle for them than alternatives, it needs to have some real advantages. One of those being a seeding relief. I think that will help to make it more attractive. But I think there is combined the demand for an onshore structure, which obviously investors, particularly UK investors, sovereign wealth funds, often prefer to have a structure within a regulatory regime they feel they can trust, but that provides a simple and easy replication of direct investment in terms of tax. Then we'll have the best of all worlds.
Thank you. And I mean, once the legislation is in place, assuming it goes in the direction we hope, what will be the process for setting up either of the vehicles, and how long do you think it will take? Melvin, do you want to go first on the PIF, and then I'll bring in Peter on the LTAF?
With the PIF, one would hope for the secondary legislation, plus there'll be an associated FCA consultation. There will need to be the infrastructure with a registry, and then one would have thought the PIF could easily be established. as I said in my presentation, similar to an English limited partnership, by way of a deed for promotion purposes, an IM or equivalent document, and one's able to operate, having in place the AIFM and the depository. There is no need for having prior approval from the FCA. So a speed to market solution, which is so key when launching funds.
Yeah,
Peter?
thanks. Yeah, thanks, John. So yeah, I think for LTAF, the time to market will inevitably be longer than it will be for a PIF, because as Melville explained, that the PIF it will not be an authorised vehicle, so they will not need pre-approval from the FCA to launch, as long as the manager has when he has the sort of the AIFM permissions under the AIFMD. For the LTAF, there will be a slightly longer lead time in terms of both the governance required ahead of application, the product design, identifying the market, and also getting the FCA approval. At this stage, we don't have a firm indication of what's the expected authorization time will be for an LTAF from the FCA. But again, given the pressure, given the Chancellor's commitment to for LTAF to being launched within by the end of this year, the FCA would be very mindful of that. One of the positives as well of the FCA when it comes to fund authorization, which isn't always well recognised, is that the FCA do set very strict SLAs on all their authorizations. So they do commit to. But they do commit to considering new approvals within a specified timescale. So for a NERS, that's currently 2 months. For uses, that's 6 weeks. And for changing existing fund, they have to respond to that within a month. And so they largely stick to those timetables. So that does give a fair amount of predictability. So once the FCA have indicated roughly what time they think will be needed to authorise an LTAF, then that should give a fair amount of predictability to product managers as to how long they'll need to take them to market. Well, we're of course one of the ask the industry is that those turnaround times are sort of kept to as quickly as possible, but then clearly the FCA also need enough time to sort of look at the proposals and ensure that they're comfortable with those going to those markets. So I think the predictability will be an important selling point for this.
I guess, Peter, I mean, the other thing with the LTAF that isn't the case with the PIF that we need to factor in to the world being ready to adopt them is that for DC investment and retail investment, the platforms are hugely important. And as you mentioned in your presentation, the platform, the investment architecture is quite key. And I know there are sort of discussions going on in the background, and the FCA are kind of strong-arming the platforms. Do you know where that's got to? The sort of process of getting platforms able to accommodate something other than daily trading.
So this is something that the productive finance group I mentioned is actively considering. I mean, you recognise this is a significant barrier to structures such as LTAF being adopted at the moment. At the same time, I mean, that any change to operational procedures and systems within platforms requires a huge investment, and in a sense, it can be a chicken and egg situation, because without any without any sort of perhaps longer term limited redemption products being offered, then why would a platform change its system? So we are aware that some platforms, perhaps particularly in the DC space, have already adapted their systems so they can accommodate less liquid investments. So coming back to the point about we see this as a gradualist approach. We think that there will be some players who are ready to sort of move perhaps a bit more quickly in the space than others, and that can happen potentially on a more gradual basis as others are sort of ready to move, but it won't be overnight change. This will be a significant change to the existing infrastructure. We very much recognise those challenges, and we've been engaging with platforms for some time now on some of these. So But at the same time, the Bank of England has very strongly signalled that it expects fund structures, especially authorised fund structures, to be more structurally aligned to the liquidity of the underlying assets. So there are quite a lot of signals coming from policymakers that the world needs to sort of adapt. So I mean, platforms will be very much mindful of that.
I mean, there's a question from Stuart Beaver actually asking if you can expand, both of you on, or all three of you, on the liquidity provisions for the LTAFs and the PIFs, and how we see those fitting together. Do you want to start off with the LTAF, and then I'll Melville can expand a bit on what he said on the PIFs.
Yeah, so I mean, ultimately with the LTAF framework, we've decided to design it so that a number of approaches can be adopted by managers depending on what they're trying to achieve in terms of strategy. We've suggested that that the FCA aren't overly prescriptive as to what the liquidity terms are, but that they allow managers in their applications when structuring the funds to sort of put in place redemption structures that they believe that they can meet from the underlying assets, and there may be a number of ways of delivering that liquidity. Whether that's through sort of secondary sales of assets, or whether that's through sort of staggering the lifetimes of underlying investments, so that's they mature at intervals that coincide with the redemption intervals. Clearly, the notice periods be a very important part of that, because there's no point in having redemptions. Infrequent redemptions if the investor can give an instruction a day before the redemption date saying I want to withdraw my money. So having that notice will be very important for managers as they plan their portfolios. So that will probably, the redemption terms offered will very much depend on the underlying sort of asset mix that the manager decides to offer, and clearly there's scope perhaps to include some perhaps some listed assets or listed alternatives within that, if managers choose to do it that way, or perhaps hold some level of cash buffer. Although the idea of the limited redemption terms is try to sort of avoid that being need to be too significant. But so there are lots of ways this could be delivered potentially.
My pet subject of deferrals and matching, but we can have a whole separate hour on that. No, not everyone agrees with me. Melville, do you want to have a chat about do you want to comment on the PIF?
Yes.
And then we'll probably have time for one last final question.
Yeah, so the PIF gives flexibility, and it's a good question, Stuart, because it creates the opportunity for the manager and professional investors to have a regime which matches liquidity between investor expectation and underlying assets, illiquid or liquid. It's that flexibility and being able to operate onshore with the tax advantages, which I think are very appealing to that flexibility of what investors and managers need. Christopher, you're welcome to comment.
Yeah, I mean, I think one of the key attributes of the ACS regime is that because it has a tax transparent nature and yet is open-ended, it means that in practice it's only really suitable for a situation where all the investors are exempt, because the practicalities of providing tax reporting information to investors who are coming in and out of a fund is pretty much insurmountable. In the context of a structure where liquidity is more under the control of the manager, where it can be designed either to be a closed-ended product with money locked up for the life of the product, or an evergreen fund, there is at least for an extended period knowledge by the manager of who is investing in the fund and what they need from a tax perspective, and it can be set out in the terms of the trust deed how that information will be provided, which means that we can then have a product that both taxable and exempt investors can invest together and each benefit from their own status in terms of treaty access and so on.
You've got, I think, time for one final question, which is linked to this liquidity of underlying assets, which is an interesting one that's come in from Michaela Wilson, who's asked, how does this proposal overlap with the new IPSX stock exchange for listed single asset property companies? Which to me, I think there's an interesting question whether that's a thing that these new funds might invest in. Peter, Melville, any thoughts on that as our final question?
Yeah,
Christopher as well.
Yeah, very, very brief. I think, I mean, there's clearly lots of organisations out there that are looking at sort of creating sort of secondary liquidity in some of these asset classes, and I think that has to be a positive development. It does potentially increase the range of liquidity options available to managers of illiquid assets. And I'm sure we'll see some of those. We're aware that there are informal secondary markets in a number of different illiquid assets, but organising some of those will only help in terms of providing liquidity options. But I mean, what funds do is bring the benefit of collectivising investments and different investor groups as well, which can also help with liquidity management. So I'd love to sort of expand on that a bit more, but I think we have to hand over the other panelists, otherwise
yeah, sorry, I think we could have a whole other seminar on that as well. Melville, Christopher, do you have any final comments on that before I bring it to a halt?
Well, just briefly to say, I've had a constructive dialogue with IPSX, and there's a podcast in August where I expressed how they could both work together, the PIF and IPSX, in terms overall of expanding the choice of UK fund solutions, which is overall what we need.
Did you want to add anything, Christopher?
No, I mean, I think it's the you know, if all of these proposals can work together and effectively have act as feeder vehicles for one another, we can provide something that will work for all of our investors, whether they're retail, institutional, exempt, taxable, and you know, I think there's some really positive opportunities here.
In which case, we're already, I'm afraid, a couple of minutes beyond our official end time. So if I could thank our panelists, Peter and our speakers, Peter and Sheeta, Melville and Christopher, and thank you all the audience for attending. A recording of this will be available afterwards. And can I encourage everyone to respond to the consultation supporting the proposals. I mean, there's a mixture of sort of technical and non-technical questions in the consultation. You don't have to answer every question, but if you think these new fund vehicles are a good idea, I think it would be immensely helpful if there is a large number of responses to the Treasury telling them that you think they're a good idea and that you can see potential uses for them. In which case, thank you very much, everyone. You're all on mute, so the panel won't be able to hear you clap, but could you give them a round of applause anyway? Thank you very much, everyone.